Morning everybody, Simon Dixon here. So two really frequent comments, questions, suggestions. One finance related, one technical related that I've had since starting all these streams and giving daily content is number one, get a tripod. Well, we got one, so you'll notice that there's not a shaky screen today. The only other thing I'm trying to figure out is the final piece of the puzzle, which is how I can stream across all my different networks while having it on my phone, which is the final piece of the puzzle. The second thing is what is going to trigger off the financial crisis? So what I'm going to do today is just go through several trends, several things that people need to be aware of, and any of these really could lead to the triggering off of the next financial crisis. So for those of you that are new to my streams, head over to my Twitter. You're probably watching this on Twitter now, or head over to my YouTube channel, which is Simon Dixon. And I've been given a lot of content on Bitcoin, economics, banking. A couple of videos that you might want to check out was the one on what will happen in the next financial crisis, and the whole theory of how digital currencies will come into play. So please check that out. And yesterday's stream, I gave a step-by-step account of what all the different countries are doing to react at the moment. The most interesting thing, obviously, this week, and I don't want to go too in detail here, is the power play amongst Silicon Valley versus Wall Street, because Facebook is launching its own cryptocurrency, and politicians and lobbyists and tech companies and everyone all around the world has been engaging in the regulatory conversation, bringing to the forefront some of the most important conversations that we'll be having over the next decades ahead, as Facebook had their Senate hearing and banking committee hearing. And as I've experienced over the decades of meeting many politicians, trying to help them understand the challenges of banking, the people at these committees, like banking and finance committees, have zero understanding about how our financial system works and some of these trends that I'm going to be discussing today, which is a really, really scary thought, but that's how the world is. You know, there's a bit of a power play where Russia has got a tech company, or a Russian tech company like Telegram, who is focused on encryption and privacy. They're launching their own cryptocurrency. And then you've got in China, you've got WeChat and Alipay. They actually WeChat disrupted cash in China a long time ago. It's been going on for quite a while. And the different policies around that. And now obviously the US is looking at Facebook, and Facebook has denominated their cryptocurrency division, subsidiary, whatever you want, in Switzerland for reasons. So anyway, diversion. I want to go through these 7 trends that I discussed in the tweet. So what are these 7 things that could trigger off a financial crisis, and some of the events that I talk about? I do encourage you to go back to those videos to say how this could play out. So let me pick off just 7 random things, and there's probably more, but these are 7 of the scariest things that exist today that could trigger off the next systemic risk event or massive reallocation of wealth and assets in our financial system. The first one is obvious, which is government debt. So government debt is out of control on a scale that we've never seen before across the board in almost every major economy in the world. So government debt is the biggest problem that we have, because the government have been using financial markets in order to borrow excessive amounts of money to the point where they can never meet their liabilities. Every time there's some kind of financial crisis, if you have an issue with corporate debt, if you have an issue with banking debt, if you have an issue with individual debt, then they use financial innovation through Wall Street investment banks or global investment banks in order to rehypothecate debt. And the way that governments do it is they use the bond market. The bond market comes with a credit risk rating. So when you're lending to a government, The rules of the financial market have always been, when functioning well, the higher the risk you take, the higher the return you get. And financial markets, when running efficiently, are meant to operate off a higher risk, higher return, lower risk, lower return. But that has actually gone through a point of inflection with government debt. So at the moment, there's many reports stating that government debt has actually gone into negative returns. So all of our pension money, all of our insurance money, all of our money that's pulled together through the financial system is actually a vast sum of it is either invested in stocks or bonds predominantly. And bonds is lending money to governments, unless it's corporate bonds, but I'm talking about the treasuries and government level. And so all of our world money is being pulled into an asset class like bonds, which are actually giving negative returns at the moment. So we're in a very interesting time where governments have actually maxed out their credit rating to the point where they're beyond anything they can repay ever. It's off the scale. And so the easiest thing to do is implement things like in the US, they have a debt ceiling, but every time it reaches the debt ceiling, they increase the debt ceiling. So we've got this ever increasing ceiling, which kind of defies the definition of a ceiling, right? But anyway, so you got negative yields on lending money to the government, one of and as these debts go out of control, remember what happened during the last financial crisis? Well, the investment banks and the retail banks co-opted the ratings agencies, and the ratings agencies were stamping subprime loan products, credit default swaps, and products that packaged together all these mortgages from people that couldn't afford to repay them, and reclassified them as AAA so that they could get a lower interest rate and be considered safe. That's essentially what's happening with government debt at the moment, is co-opting the ratings agencies, stamping a higher credit risk on those, which is decreasing the yield because it's considered low risk. And therefore, you're in this negative yield analysis with the highest risk any of these assets have ever seen, because their level of indebtedness and ability to repay products that are never due to be repaid are at all-time risk levels. So, when we have a situation like now where America comes out and the finance treasury minister says, if we don't increase our debt ceiling, we run out of money and we cannot meet our obligations by this September, then that can lead to a credit rating downgrade, and that can trigger off an exodus away from negative yielding bonds, which aren't producing returns but have excessive risk. And so a credit rating downgrade, governments know that, and therefore they have to co-opt the ratings agencies and try and make sure that does not happen for the good of the country. So one of those, that's one trigger event. The second one is that we have a stock market that has been completely propped up and is at all-time highs, while economies have been booming because consumers have been using debt to actually consume goods. Businesses have been rolling over debt in order to consume, and governments have been consuming at an ever-increasing rate, trying to fix their employment problems in their economies. So therefore, there's been a lot of consumption, but most of that consumption has not been done through savings, it's been done through debt. So therefore, we have a stock market that's propped up by debt, but also we had the largest central bank scheme of injecting money into the financial markets by lending artificially at artificially low rates to large corporations, banks and financial institutions through quantitative easing, which is where the central banks essentially leverage their balance sheet and put billions and billions and billions, probably trillions now, into the economy, which allowed some of the larger companies to have excessive profits, whereby they could buy back their stocks and go through stock buyback schemes. And also it looked like the economy is better because we've got people consuming on excessive debt. And so therefore you've got debt levels at the both government, corporate and individual level increasing, which eventually at some stage you can't rehypothecate anymore. And when you can't rehypothecate, people will stop spending. And we realize that we've got a stock market that's just been artificially propped up by quantitative easing, which is an experiment the world has never seen, and we don't know the end result of that. But that could be, an exodus away from stock market. So then you've got 1, the bond market, 2, the stock market. What else have we got? Just looking at my notes. We've got negative interest rates as well. So there's been a global movement towards discouragement of savings. When the government outsourced the ability to create money to the private banking sector, essentially what they did is they propped up the dependency of their economy on the private banking sector. The fractional reserve banking is the process of a bank not needing a deposit in order to issue a loan. So when you take out a mortgage, the money doesn't exist. It's not somebody else's pension. It's just created as a data entry in their computer system, deposited to your account. And as you repay that money, the money supply shrinks because it was brand new money. Or if more and more people borrow, then the money supply increases. And therefore you have all digital money. The banks were the inventors of digital currency. They invented it when they were essentially creating computer money backed by debt, by lending you mortgages and all these different products and these loans. So now we've reached a stage where banks, governments, everybody would much rather you spend on debt than save. And so they're discouraging savings because as bonds yields go down, as stock markets reach, pumped up artificial rates, then discouraging savings is the only way you can push the stock markets further by putting savings, interest rates down to the point where they discourage you from leaving money in a bank through negative interest rates. And so it costs you to actually hold money, and therefore your best bet is to take on debt and to spend money, knowing that there'll be a mass default of this debt later. So the discouragement of savings could lead us into excessive debt levels, again, new all-time high debt levels, as savings products have completely broken down in terms of encouraging people to save, to the point where many economies are relying on negative interest rates, punishing the saver, encouraging the person taking on debt. What else have we got? An insolvent pension scheme. So many people are relying upon their government pension to retire. Certain demographic, like baby boomers retiring, is reaching the stage whereby many of the pension schemes, particularly the government-run pension schemes, don't have enough to meet the obligations. And when they have to meet their obligations, the only way to do that for a pension fund is to actually sell off some of their assets. When bonds are actually producing negative yields, negative returns, when stock markets are artificially pumped up by debt, and you need to meet many of your obligations in order to pay the pensioners, you're either going to get defaults of obligations, insolvencies, or you're going to see them looking at different asset classes, and they just can't meet their obligations. So they're either going to have to take excessive risks and reallocate to different types of asset classes, especially as some of the trends that play out, that I'm forecasting will play out with the disruption in Bitcoin and crypto markets. So an insolvent pension scheme, searching for yield. Now remember, these pensions are looking for higher and higher yield in order to meet their obligations. So traditionally they've invested in lower risk asset classes like bonds, but as those are producing lower returns and negative yields, they've been putting it into more speculative assets like stock markets. Now that's been performing well for them because it's artificially propped up by debt. And so therefore, when those yields go, they're going to have to do more risky things with their money in order to try and meet some of the obligations that they can't meet based upon their current trajectory. So that's the fourth one. The fifth one is another trend, which is over-dependency by young people on student loans. So many students all around the world bought into the belief that if they take on a student loan, they could get a good job at the end of it and they could start to pay down their debt. Most students are in the beginning of a debt cycle because they believed in the promise that if I get myself qualified and borrow money, then I'm going to be able to get a better job in the future. But the problem is that everybody did it at the same time, and every student now has degrees, masters, MBAs, everything coming out of every direction. And they've started the debt cycle whereby, let's say a student from India who was earning money in India came over to a country like the UK. They earned their money in rupees, they saved their whole life, and they gave all of that money to the university system because the level, the fees in pounds or dollars at these top universities versus earning money in rupees. And the university started charging higher and higher prices to overseas students, discouraging their local students and accepting that there's more money in taking on international students, which has created a ginormous force of student debt. Most students are they'll take on that debt and then they never get out of that cycle. They get a job, the job doesn't cover their debt, and therefore they start using credit cards, they start rolling over that debt based upon the fact that they have income. And then that's the perfect type of customer a bank is looking for. It's why a bank gives 0% interest student loans, even though it's high risk, is because they want you to start the debt cycle with them, hoping that you'll get a better job. Once you get a better job, you'll start rolling off the debt. The best customer for a bank is someone that can afford the interest, but not the repayment of the principal. And that is what student loans have driven many people into. So we've got an over-dependency on student debt by young people, and many of those loans are just disappearing into the bureaucracy of the financial system and government system. So those are big problems. Now, what was really interesting is during the last, the ICO boom and bust and the crypto boom and bust, there was record levels of interest from young people and students that were actually thinking about savings and investing for the very first time when they saw cryptocurrencies. And so really, although many of them would have invested in scams and all sorts of things that made them lose their money, the fact is that cryptocurrency produced a force of savings and investing. You might call it speculation and trading if you want to put it from a negative context. But these were students that were never going to invest in bonds, never going to invest in stocks, never going to invest in commodities. But some of them got very wealthy as a result of looking at the crypto market because it was aligned with their ideologies. And it was just a product that they felt was interesting to make them think about not student loans, not mortgages, but actually investing, saving, speculating, and trading. And so remember, if you look at my video yesterday, is the whole concept of everybody is a speculator, but some people outsource their speculation to other people instead. And so you've either got to choose to speculate yourself or outsource your speculation to somebody else. But whichever way you look at it, everybody is a speculator and they have to choose. So anyway, there was a counterforce there in crypto. The next one is credit card debt. A lot of people are using the credit card system in order to roll over the fact that credit cards give them 0% interest for a year. And therefore, a lot of people are taking a lot of their student loans, a lot of their mortgages, and they're rehypothecating it through the credit card system. And so therefore, there's a lot of people that have credit cards that at some stage are not going to be able to repay those, have no intention of repaying them, and all they're doing is they're subscribing to a new credit card offering them 0% interest, and they're switching their debt from one credit card to another and playing the system Therefore it's led to a massive over-indebtedness on the credit card system and what could be a credit card crisis coming up. So we've got that's another force that could be the trigger. Remember, the system is so fragile that all it requires is one systemic risk event, and because the whole system is systemically connected, this is where you could have a mass reallocation of assets as a result of some of the things that can happen. So the final one is really an over-dependency upon the property and real estate market. So because banks have the license to create money, they have traditionally always chosen to create money by issuing a loan for the asset class that they think is the least risky with the highest return. And the least risky, highest return asset class in a world of fractional reserve banking, where you can create money every time you issue a loan, is real estate through mortgages. So over 40% of everyone's balances are being used to leverage up mortgage loans and create new deposits and stimulate the property market and economy. Most people, many people, are relying upon their property to bail them out as part of their pension. And so their real estate is really what they're pinning most of their hopes on, because traditionally the property and real estate markets, depending on where you are in certain economies, have doubled every 7 years, and many people have built a whole, living around their real estate, their property. But there is now a complete over-dependency upon that. And because many people knew that, governments have put together many initiatives in order to encourage home ownership. And their home ownership schemes were, in fact, the exact things that caused the subprime crisis that was one of the trigger events to the last financial crisis, which is where they encourage people to take on, what they were called liar's loans, literally. And then the reason that was happening is mortgage brokers were encouraging people to take on loans and own their own property. And then they were the retail bank was no longer actually taking the risk, because they were packaging those products off, handing it over to the investment bank. The investment bank was then taking those products and slicing and dicing them and pooling them together into a collateralized debt obligation. And then they were getting another company like Lehman Brothers to take out insurance and allow people to buy insurance on those products through credit default swaps. And then they were taking those products and they were slicing them up into smaller pieces when nobody knew what was the credit risk of those loans. They were co-opting the credit rating agencies in order to stamp them as low risk, which gave them a lower yield. And then they were selling them to your pension and your insurance companies. Then hedge fund managers were speculating on them. And if they got the right side, whether they were short them or long them, it created, a massive redistribution of wealth in the last financial crisis. So we're still in the same system. Countries all around the world are encouraging home ownership so that they can stimulate the economy, so that the banks go out and lend money on mortgages, and that's creating artificial prices for real estate and property, and a continual over-dependency by people thinking that their property and real estate will bail them out from their student loans, from their credit cards, debt, and all that type of stuff. So let's just do a quick recap. These are 7 trends that are all coming together. We've got low-yielding government debt through negative bond yields. We've got stock markets that are reaching all-time high, but propped up by quantitative easing and excessive consumer and business debt. We've got discouragement of savings through negative interest rates, and a complete push towards not saving. And also it doesn't make sense as well, because you've got to work harder and harder and harder just to receive negative interest returns. You've got insolvency in pension schemes and obligations that they can't afford to meet, driving them to take higher risk and search for yield. You've got an over-dependency on students, on student loans, which is pushing them into a debt cycle, which is holding up the economy. And then you've got credit card debt, over-indebtedness as well, rolling over, zero interest rate loans, and encourage and putting people into debt cycles forever. And a complete over-dependency upon the belief that real estate and property prices will continue to increase, but they only increase because they're artificially pumped up by the banking sector and ability to create money. So sorry if that's really negative. These are 7 trends. They exist. They're real. You're going to have to decide how to navigate that. I've created lots of different videos helping you understand some of the trends and some of the things that you can start using in order to make your own opinion, do your own research, and start deciding not how someone else is going to speculate for you, but how you're actually going to manage your finances in these. So I believe that any of those could be a trigger for a financial crisis, and it could even be something that I didn't even put there, 8, 9, and 10, millions of other things that can trigger off the system. Sometimes it just creates a tiny little, a tiny little domino start in order to get the whole systemic risk event going. In other videos, I also talk about the importances of cryptocurrencies and Bitcoin and how it's a counterforce across many of these trends. And check out my video on easy ways to actually purchase Bitcoin and things that you need to know before doing it. I have no interest in you purchasing Bitcoin. I just know it's something that I think a lot of people are going to have to adjust to. And I'd rather them be prepared for that rather than doing it in a panic when everyone's trying to get on board, because there's only 21 million of them. And I believe personally that there's going to be a scarcity in the allocation of those 21 million Bitcoins when approximately probably 5 to 6 million of them have all been lost, never to return again. And the supply of them is increasing at a smaller and smaller rate as we move over to the halving of them in 2020. Anyway, so remember, if you're interested in what will happen, I do not believe in the doomsday scenario. I do believe that there's solutions here, and I believe that governments are actually going to let the banking system go bust and without you losing your deposits. In order to understand how that's going to happen, check out some of my videos where I talked about what the governments are going to do during the financial crisis. Check out my YouTube channel. If you like this content, please share it, please retweet, please like. I'd like more and more people to get these messages and understand and be exposed to some of these trends. If you hit the subscribe button on my YouTube channel, Simon Dixon, and hit that bell symbol, YouTube will send you an email every time I go live. And my goal is to navigate through what I believe to be one of the most exciting times in financial history if you're on the right side of it, and a scary time in financial history if you're in the wrong side of it. I believe that we're about to encounter one of the biggest wealth redistributions that we've seen for decades, if not centuries. And I'd like more and more people to at least be prepared and hedged for some of the trends that are going ahead. So at least you can't say that no one told you. So thank you very much for that. Hope you like the new steady camera. I got more ideas of how to make these better. Bear with me, one step at a time. Really busy at the moment, but one step at a time I'll make these better and get the production quality up. And I'm really excited about the studio that I am having built out, but it's going to take a little while because we've got several things that we're doing before we do this. So thank you for your time. Have a great weekend. Over and out.